The job market is shifting. What we're seeing today is very different than what we saw in the job market back in 2022. Back in 2022, quiet quitting was everywhere, the Great Resignation was in full swing, and employees could quit their jobs and see huge salary bonuses by getting a new job. Today, it's a very different environment. Now, if you're quiet quitting, you're probably going to get fired. People don't want to quit their jobs anymore because the job market isn't as strong as what it was. And even if you do get a new job, you might not see the same pay raise that you saw before. I've talked about this a lot over the last number of years, but the power dynamic between the employer and the employee have been shifting. Back a couple of years ago in 2022, the power was in the hand of the employee. You had much more power because employers were more desperate for employees than employees were desperate for jobs. There were a lot of job openings and not that many people that needed a job, so employers were much more desperate for employees, so employees had the power. Now in 2024, it's become much more even, and so the power dynamic has shifted. And that changes a lot of things when it comes to work culture. For example, you're seeing many more employers feeling more confident in implementing stronger work policies, such as return to office. And along with that, wage growth has been falling pretty steadily. And that's why in this video, I want to go over three things. Number one, I want to go over the state of the job market. Number two, I want to go over the state of salaries. And number three, I want to go over what this means for the future for you and the job market. But first, here's a quick word from our sponsor, Vanta. If you are starting or scaling your business, you want to spend your time actually building your business, not spending your time worrying about security and compliance. And that's where Vanta comes in. Vanta can save you time and money while you build trust with your customers. With Vanta's questionnaire automation, you can complete security reviews up to 5 times faster with AI-powered security questionnaires and trust centers so you can close deals faster. There are over 8,000 companies like ZoomInfo and Smart Recruiters using Vanta to streamline security questionnaires to close deals faster. Try it out for yourself. You can take a self-guided tour of Vanta's questionnaire automation by clicking my link down in the description below, where you can scan this QR code right here. That way you can test it for yourself. Let's start by taking a look at where unemployment is. Back in 2022, the average unemployment rate in the United States was 3.6%. In 2023, it was also 3.6%. Right now, at the time of recording this video, it has jumped up to 4.1%, which historically is still extremely low. But it is a little bit higher than where we were over the last couple of years. Now, the interesting thing about this unemployment number is when we got the most recent jobs report, it came out much better than what economists even expected. Which brings us to the important question. How are interest rates impacting the job market and the unemployment numbers? We know that as interest rates went up between 2022 and 2023, we saw a surge in layoffs. And now as interest rates go down, economists and the Federal Reserve Bank are hoping that this is going to help stimulate the job market even more. And just to make sure we're on the same page, the reason why higher interest rates have contributed to more layoffs and a rise in unemployment rates has to do with a couple factors. Number one, there is the debt burden on corporations, and number two are the slower sales that corporations see. Starting with the debt burden. We know that most corporations in the United States, or many corporations in the United States, have debt. And many of these corporations refinanced their debt back in 2020 and 2021 when interest rates were at their lowest levels ever. Well, corporations don't get a 30-year fixed rate mortgage, they get a 3-year or 4-year or 5-year term on their loans. And so in 2024, many corporations for the first time are starting to see these debts start to readjust at a much higher interest rate than what they readjusted it at back in 2020 or 2021 when interest rates were at their lowest levels ever. Which means for corporations, their costs of doing business are rising, not just because of inflation, but because their debt servicing costs are rising. Even if a business hasn't changed how much debt they have, their cost on the debt will go up when the debt readjusts. But the second part to this isn't just now the business paying more interest on that debt. It's the fact that slowing sales can also be caused through higher interest rates, because when interest rates go up, that makes borrowing more expensive. And we live not only in a consumerism culture, but we live in a credit-based spending culture, which means our economy runs on credit, not just the cash in their bank account. So if somebody has $100 in the bank account, that doesn't mean they can only spend $100. It means they can spend $100 plus whatever Visa will give them. And when interest rates go up, people are less likely to go out and put money on their Visa, and Visa is less likely to extend as much credit. That means that spending abilities go down when interest rates go up, and businesses need people to spend money in order to sustain their sales. So as interest rates go up, the cost of a business also go up, because that means they have to pay more money on their debt, and then revenues can also get hit or not grow as fast because that means people and businesses can't spend as aggressively as they were before when interest rates were lower. And that's how businesses get impacted when you have higher interest rates. And to really hammer this point home, take a look at what Goldman Sachs published. They published an article on their website titled, "Is United States Consumer Spending Losing Momentum?" And then they went on to say that spending growth has slowed from above 3% in the second half of last year to a trend rate of probably around 2% today in 2024, which again means that as interest rates go up, businesses might not be able to forecast as aggressive of sales as they can when interest rates go down and people can go out and borrow more money easier. But now you have a lot of businesses hoping the opposite will happen, that now as the Federal Reserve Bank is cutting interest rates, it will number one, stimulate spending, and number two, it will allow businesses to readjust their debts at a lower interest rate. And this is where everybody is wondering how aggressive the Federal Reserve Bank is going to be when it comes to cutting interest rates. Now, when you get numbers that the job market is stronger than expected and inflation is better than expected, that doesn't give the Federal Reserve Bank much fuel or ammunition to keep cutting interest rates very aggressively. And this is where a lot of people on Wall Street and every investor is paying attention to what the Federal Reserve Bank does, because they want to know how aggressive are they going to be when it comes to cutting interest rates, because that can impact, number one, how expensive the debt is going to be for corporations, and number two, what future sales might look like for those same corporations. And this brings me to number two, the state of salaries in America. Now, salaries have risen across the board between 2019 and 2024, but that doesn't give you the full picture. And what you want to pay attention to is how fast are salaries rising relative to the price of things. And what we've seen is up through the beginning part of 2024, inflation outpaced salary growth. But then in the beginning part of 2024, we finally got the good news that wage growth was outpacing inflation. And that naturally had a lot of people very excited, but let's take a look at this chart. If we zoom out, what you can see is that there was this big period where inflation was outpacing wage growth. And now, as wage growth is outpacing inflation, does that make up for the big gap where inflation was outpacing wage growth? So let's dig into the numbers. Between 2019 and 2024, the reported inflation number over these 5 years is just over 23%. I'm rounding down here on the inflation numbers. Over that same time period, household income grew from around $68,000, $69,000 a year to an estimated $81,000 a year, which is a growth of just under 18%. I am rounding up here. The average sales price for a house in America went from around $258,000 to $433,000, which is an increase of around 67%. And the average new car sold in America went from about $38,000 in 2019 to just under $48,000 in 2024, which is an increase of around 24%, which means between 2019 to 2024, we have seen a growth in expected household income. I say expected because we don't know the actual household income in America yet. We'll find that out in 2025, but the expected growth in household income is around 18%, while the growth in reported inflation is about 23%. Now, of course, the real inflation that many Americans feel is actually higher than that, but even the reported inflation numbers are higher than the growth in household income. And the growth in household income also does not keep up with the growth in housing costs, it does not keep up with the growth in car costs. And if we take a look at the growth in college costs, well, college prices have increased by around 30%, a little over 30% over this 5-year period as well. But now we're facing this interesting conundrum that as the rate of inflation falls, so is the rate of wage growth. Take a look at this chart. This is a chart from the Federal Reserve Bank showing wage growth in America, and you can see the fairly steady decline in wage growth ever since 2022. Now, of course, we've been covering all of this in Market Briefs, my free financial newsletter. If you haven't joined that yet, I got the link for you down in the description. But this is where I want to discuss number 3. What does this mean for the future of the economy? What we have seen, not just over the last 5 years, but over the last number of decades, is that we have seen growth in income. But the growth of income has not kept up with the growth of inflation, and the growth of inflation has not kept up with the growth of asset prices. What do I mean by asset prices? I mean things like stock prices and housing prices. Now, hear me correctly. This doesn't mean the stock prices always go up. This does not mean the housing prices always go up. We see market crashes, we see asset price crashes, we see recessions. But despite that, over the long term, what we have seen is that incomes have not kept up with inflation, and inflation has not kept up with the growth in asset prices, because the inflation disproportionately benefits asset prices and investors more than it benefits incomes. Now, there are some industries that have seen bigger booms in incomes than others, But what I want you to understand is that this trend, even if inflation falls, isn't going to necessarily go away. We know that between the 1970s and today, the value of the dollar has fallen. What $100 can buy you has fallen. And yes, incomes have risen, but they haven't risen fast enough to keep up with the growth of the cost of living and the growth of the standard of living. Which means if you really want to be able to build wealth, yes, it's nice to have a good income, but it is important to transfer this income into assets. Now you might be saying, well, Jaspreet, there's still worries about a recession. There's still worries about market prices and asset prices, and what if the markets crash? Okay, fine. But market crashes have happened in the past, and they will continue to happen in the future. And what we know is if you continue buying good assets, well, chances are, if the economy continues to grow, that you're going to be able to continue to see that growth in asset prices, which will outpace the growth in incomes. Nothing wrong with working a job. Nothing wrong with seeing growth in incomes. But if you really want to be able to build wealth and be on the right side of the economy, you have to be an investor, because asset prices have historically grown faster than income rates. And if you want to build wealth, you have to be an asset owner, which means you have to be an investor. We just entered the next phase of the global economy. The Federal Reserve Bank is now cutting interest rates. Canada is cutting interest rates. China is now cutting rates, and countries across Europe are also cutting interest rates. And we've also seen some countries, on the other hand, now start to protect themselves against any sort of potential economic uncertainty by buying things like